Hello and welcome. This is basis period still we are at the basis period, but now we will look at some complex issues which are only relevant to ACCA P6 taxation. Now in the previous lecture, although we did 6 examples which were dealing with different basis periods, from first basis period to the third one, then the subsequent and the closing basis period, which was the last one as well. Now you might be thinking, we have been dealing with difficult basis periods so far, but you haven't seen the complex basis periods yet. How? Because you might not be able to see all of these examples now, but let's look at the example number 5 please for now, because all of them were exactly the same, the thing which I am going to tell you. Now say for example these were the accounting periods, and there were different accounting periods for all of these examples. Now all of these examples you might have already noted down on your notebooks, that in all of these examples what happened is that there was a accounting period given to us. Now although the accounting period was given to us, but there wasn't any change in the accounting period. So there was exactly the same accounting period. So it was one period started from this date and it is ended on the next date, and the next period started just after the the previous period ended. Now say for example in this example, 1st of the 1st 2012 to the 31st of the 12th 2012. Now it is ending on the 31st of the 12th 2012, so obviously the next period is going to start on the very next day, right? So this is the thing which was happening in all of our examples which we have been dealing in the previous lecture. But when we look at the P6 section of basis periods, it's not only this bit which we have so far covered. There is additional thing as well, where the businesses change their accounting date. Now say for example this accounting date started on 1st of the 1st 2012 to 31st of the 12th 2012. Now after that he decided that although his year end was 31st December 2012, then he thought about changing the year end. So instead of the December 31st, he thought, why shouldn't I make it to 30th of June every year? So when he decides to change the year end, then the issues about the basis periods will also change, because it won't be as simple as we have seen so far. So there will be little complex issues, and so now we will study them issues. Now when we change the accounting date, assuming we are the businessman, so when the businessman changes the accounting date, it will result in either shorter accounting period, which will be the new one. It will result in the shorter accounting period or longer accounting period. Now when I say shorter accounting period, obviously when say for example his year end was 31st of the 12th, then after that when he changes his accounting date, obviously the next one will be either the short or the the long one, right, when he make the change. Otherwise if he just kept like that, then it will be 12 months anyway, right? So when he make the change about the accounting date, then in the year of change, the accounting period will be either short period, which will be less than 12 months, or it will be long period of accounts. All right, when I say long period of account, it means more than 12 months. So there will be 2 cases, although there will be overall 4 cases, but the 2 scenarios. So one scenario is that change will result in less than 12 months accounting period, and the other scenario is that change will result in more than a 12 months accounting period. So there are 2 different scenarios, although there are 4 cases, but the scenarios are only 2. So we'll be dealing in both of these cases. Now say for example if he made a change about the accounting date, and then after the change, the new in the year of change, so say for example if he made the change about the accounting period, now in this year, this will be the year of change when he made the change about the accounting period. So in the year of change, say for example it resulted in accounting period of more than 12 months, then there will be different rules. If it resulted in less than 12 months, which is the short period of accounts, then there will be different rules. All right, now there are 2 cases for each of these. So 2 cases are relevant to when it is more than 12 months, and 2 cases are relevant to when it is less than 12 months. All right, but the scenarios are 2, as I said. One will result in the accounting period being more than 12 months, and other one results in the accounting period being less than 12 months. All right, now I will just quickly go to the notes and I will share the screen. Now as you can see on your screen, that is chapter number 7, which we were doing in the previous video as well. So it is on the page 31. Now if you go to the next page where it says change of accounting date, excuse me. Now where it says a change of accounting date on the page 32, so look at the first scenario. Now in the first scenario, what it says is that when change of accounting date results in one short period of accounts. So he made a change in the accounting period which resulted in one short period of accounts. So when he makes a change, so obviously in the year of change it will be short. After that, the following years will be 12 months, but in the year of change the problem will be only in the year of change. All right, so he made a change in the accounting period, so which resulted in less than 12 months accounting period, which is known as short accounting period. So in the case when it says when change of accounting date results in one short period of accounts which is less than 12 months accounting period, so what would happen in that case? Now what does the rule says that the basis period for that year is 12 months to the new accounting date. So it will be simply 12 months to the new accounting date. So whatever the new accounting date will be, we'll change it to the new accounting date. Now on the left side is the example given, which is normal accounting period, and the basis periods are given on the right side of your notes, as you can see on your screen as well. Now on very left side there are different accounting periods are given. Now he was making his accounts from 1st January 2000 to 31st of December 2000. So 31st December was the year end every year, and the profits are given on the right side of it as well. Now the 31st December was the year end every year. Then he thought that he will make a change about the accounting period, and he will make his year end will be the 30th of June every year. So when he wanted the year end to be 30th of June, obviously it will result in a shorter period of accounts. So he made his accounts to he made his accounts 6 months to 30th of June 2003. All right. So when he made the change, of the accounting, when he made the change of the accounting period, just look at the shaded area where it says from 1st of January 2003 to 30th of June 2003. So previously the year end was 31st December, whereas in this year it is 30th of June 2003. So he made a change about the accounting period, which resulted in a period which is less than 12 months only in the year of change. If you look at the following years, they are again 12 months, so there is no need to change anything about the following years. There is only problem in this year. So what does the rule says? Rule says that it will be 12 months to the new accounting period, 12 months to the new accounting date. So 12 months to the new accounting date means that the basis period will be ending on 30th of June 2003, whereas we will take 12 months back to that because it is 12 months to the new accounting date. All right. So if you look on the right side where the shaded area is, so the basis period will be to the basis period will end on 30th of June 2003, and obviously when it is 12 months, so it will start on 1st of July 2002. Right. So what happens is that when change results in a short period of account which is less than 12 months, then what we do is we'll make accounts to the 12 months account to the new accounting date. So the new accounting date is 30th of June 2003. Now if we take the 12 months before that, obviously it will start on 1st of July 2002. So 1st of July 2002 to 30th of June 2003. All right. Now if you look at this shaded area, 6 months of profit, if you look at the profit, 6 months of profit has been overlapped. All right, because period from 1st of July 2002 to 31st of December 2002 has already been taxed in the previous tax year, whereas it is being taxed again. And when it is being taxed again, obviously it will be overlap profit. Now just look at beneath that. If you look beneath that, there is assumption in the question which says that overlap profit of 6 months at the start of the trade was £6,000. So it is an assumption that there was already a overlap profit of $6,000 which was for 6 months, correct? So already there was $6,000. Now another $2,000 will be added by this treatment, by this change of accounting date. All right, how 2,000? Did you know how to calculate the 2,000? Now the profit in the previous accounting period was 4,000. Just look at the previous one before the shaded area, and the profit was 4,000, wasn't it? Now this 4,000 was for, obviously, for 12 months. So for 6 months it will be $2,000. All right. So the new overlap profit, because the previous overlap profit was $6,000, so after this change, the new overlap profit will be $8,000 with the addition of this 2,000, which is for 6 months as well. All right. Now, if you come to the next page, please, which is page number 33, that is the case 2. I told you that there are two scenarios. One scenario is that short period of accounts, where the change results in short period of accounts which is less than 12 months. We have already seen that scenario in the case 1. All right. Now in the case 2, if you look at the case 2 on the page 33, please, it is again the same scenario, but it is a different case. So same scenario means that here as well change will result in a short period of accounts. So when it says that when change of accounting date results in one short period of accounts which results in 2 accounting dates in a tax year. So he made a change about the accounting date, he made the change in the accounting date, but it was so small, it was so short that there were 2 accounting dates in a tax year. All right. So how it happened, what is the rule about it? So the rule says that the basis period for that year begins immediately from the beginning of the previous accounting date and ends on the new accounting date. So what we do is we'll take from the start of the previous accounting date, and it will end on the new accounting date. So it will be a huge, accounting period, because it will be from the start of the previous accounting period, and it will end on the new accounting date. So what happens is that to the new accounting date, resulting in basis period of more than 12 months. So obviously the basis period will be more than 12 months because the previous period will be 12 months long anyway, but we will add the new one as well. Overlap profit relief will be given up to the months exceeding 12 months. Now what is the overlap relief? We will see in a minute. Whenever you see more than 12 months, whenever you see the basis period is more than 12 months, relief will be given, overlap relief will be given, overlap profit will not be added. Now these are two different things. In the previous case, what we did is we calculated the overlap profit, and overlap profit was added in the previous overlap profit, all right? Whereas overlap relief is different thing. So whenever you see that whenever you see that we have made the basis period which is more than 12 months, then we will give the overlap relief. Now what the overlap relief is, we will just see in a minute. Now in the examples case, if you look at on the left side, in the examples case where the accounting periods are given, there are different accounting periods. So it started from 1st of January 2000 to 31st of December 2000, and it was 31st December was the year end every year. If you look at the shaded area, so he made a change in the accounting date, and he wanted the year end to be on the 31st of March every year. So when he made a change, so it was from 1st of January 2003 to 31st of March 2003. So just 3 months long. He made the accounting period just 3 months long, right? Which resulted in 2 accounting dates in a tax year. Now if you look at this shaded area, accounting date is ending on 31st of March 2003, right? It is ending on 31st of March 2003. So which tax year is it? It is tax year 2002-03. Now if you look at the previous accounting date, which is 31st of December 2002, which tax year is that one? That is also 2002-03. So he made his accounting, he made a change in the accounting date, but the change resulted in so small accounting period that there were 2 accounting dates ending in one tax year. All right. So that's what happened here. So 2 accounting dates are ending in one tax year. So first one is ending on 31st of December 2002, which is 2002-3 tax year, and another one is ending on 31st of March 2003, and that is also tax year 2002-3. Now in the year of change, the profits are $6,000 or pounds, whatever. And if you look at on the right side, where the basis periods are, so you know the first basis period is from 1st of January 2000 to 31st of December 2000, so it is exactly the same, which is on the left side. Now if you look at the shaded area, what the rule says, so rule says that from the previous from the start of the previous accounting period till the new accounting date. So the previous accounting period starts on 1st of January 2002 and it will end on the new accounting date, which is 31st of March 2003 in our case. All right, so whenever a change has made change has been made in the accounting date, and which resulted in accounting period of less than 12 months, but it is so small that there was no accounting it was so small that there were two accounting dates were in the same tax year, then this rule will apply. The rule says that it will start from the previous accounting period and it will end on the new accounting date. So the previous accounting period starts on 1st of January 2002 and it will end on the new accounting date, which is 31st of March 2003. All right, now how to calculate the overlap relief, which is given just beneath that. Now how many months is exceeding, now the months exceeding which resulted in the new accounting date, the months exceeding are 3 months, isn't it? Because from 1st of January 2003 to 31st of March 2003, so these are the months exceeding 12 months, right? Now, if you look at the overlap profit relief, it says months exceeding 12 months. So months exceeding 12 months are 3 months, isn't it? Because it is 15 months long. This basis period is 15 months long. So months exceeding over 12 months are 3 months. Now, at the start of the trade, the overlap profit was $6,000, and that was for 6 months. Now, if we take the 3 months of overlap profit, which will be obviously half of that, which will be $3,000 US. Now what we do is we take $4,000 US, which is the profit of the previous accounting period, which is for 12 months. We take that one and we'll add 6,000 into it as well, which is the new accounting period where we made the change. So 6,000 plus 4,000 is equal to $10,000, but we will give the relief of overlap profits. We will not add the overlap profit, but we will do the relief. So when we give the relief, we will also always deduct the overlap profits. So overlap profit for these 3 months was 3,000 as we calculated. So that 3,000 will be deducted out of that. So the remaining amount is going to be $7,000, which is the profit for the basis period of change. All right. So as given on the right side, which is $7,000 US, that is the profit which will be taxed in the year of change. Now next two cases, case 3 and case 4, are related to the next scenario, which is scenario number 2. I told you that there are 2 scenarios but 4 cases, and 2 cases deal with 1 scenario. So first scenario was that change results in shorter period of accounts, which is less than 12 months, and we have seen 2 cases about that. Now the third case and the fourth case will be related to the second scenario. Now this scenario is that they will make a change in the accounting period, but change will result in a longer period of accounts. All right, so it will not be shorter. Change will result in a longer period of accounts, which means that more than 12 months. So when change of accounting date results in if you look at the third one, when change of accounting date results in one long period of accounts, so change has been made that resulted in a longer period of account, which means more than 12 months. So what does the rule says? The basis period for that year is same as accounting period. So it will be exactly the same as accounting period, resulting in basis period of more than 12 months. Overlap profit relief will be given up to the months exceeding 12 months. So overlap relief will again be given. Why would we give the overlap relief? Because the months are exceeding 12 months. So that's why we'll give the overlap relief. All right. So how will we give the overlap relief? Example is given. So you know, the normal accounting periods were ending on 31st of December every year. Then he made a change, and change resulted in more than 12 months. So if you look at this shaded area, so it was 15 months long. So he started on 1st of January 2002 and it ended on 31st of March 2003, so which are 15 months long, right? So it will be exactly the same as it says that it will be exactly the same as accounting period. So it will be from 1st of January 2002 to 31st of March 2003. If you look at on right side basis period, it is exactly the same. So that's what the rule says. But we will give the relief for the overlap but we will give the relief for the overlap profits. So overlap profits of the months exceeding 12 months are 3 months long. So you know, overlap profit for the 3 months are, we know that already, it is $3,000. So the profit was $8,000, but we will have to deduct this deduct 3,000 out of the profit. So the remaining is going to be 5,000. That's what is written on the right side. All right. So that is the scenario when that is a scenario when you know, change resulted in more than 12 months long accounting period. All right. And the case 4 again will be relevant to the scenario where a change will be made in the accounting date, but which will result in longer period of accounts, more than 12 months. So what would happen here is when change of accounting date results in one long period of accounts, which results in no accounting date in a tax year. So although he made a change in the accounting period, but the change resulted in a very long accounting period, that there was no accounting date in a tax year. So what does accounting date means? When when there is a year end, it is accounting date. So it was so long that there was no accounting date in a tax year. So if something like that happens, then overlap profits will be given, no relief, but overlap profits will be given, like the case number 1. All right. So it will be added in the previous overlap profits. But how to calculate the basis period? It is a little complicated one. So what we do is, excuse me. So what does the rule say? That the basis period will have to be manufactured. So how can we manufacture it? First, what we do is we take the new accounting date. So the new accounting date will be given. Now, if you look at the example on the very left side, hang on, let me show you that as well. If you look at the left side, which is accounting period, so from 1st of January 2000 to 31st of December. So 31st of December was year end every year. Then he made a change. Now after making the change, the accounting period was from 1st of January 2003 to 30th of June 2004. Right, so it is huge overlap. It is huge accounting period, which is 18 months long. Now, although it is 18 months long, now if you look that 31st of December 2002, which tax year is it? It is 23. Now if you look at 30th of June 2004, which tax year is it? 45, right? So there is accounting date in 23 and then there is on 45. There isn't any accounting date in tax year 34, right? So it was so long that there was no accounting date in tax year 34. All right. Now in that case, we will have to manufacture our basis period. Now how can we manufacture? Just look at the steps which are mentioned above that. So first step is that take the new accounting date. Now in our case, the new accounting date is 30th of June 2004. All right. Deduct 12 months out of this date. Now how can we deduct 12 months? It means that if we deduct 12 months out of that, we will reach on 30th of June 2003. All right. So if we deduct 12 months out of that, we'll reach to 30th of June 2003. Now third step say that basis period is 12 months to this date. So the basis period will be 12 months to this date. So if we make the basis period of ending on 30th of June 2003, then obviously it will start on 1st of July 2002. All right. So that's what is mentioned on the right side, on the basis period side. So it will start on 1st of July 2002 to the 30th of June 2003. Right. Although we have made that, but it is not end. It hasn't ended yet. We will have to make the another we'll have to make another basis period as well. So the next basis period will be from 1st of July 2003 to the 30th of June 2004. So we'll have to make 2 basis periods. Excuse me. Right? So then just beneath the step 3, where it says step 3, just beneath that, if you look at it, says that resulting in a huge overlap profits, which will be added in the previous overlap profits, because we have made so long accounting periods, and there will be huge overlap profits. Right? Now, if you look at just beneath that, let me show you as well on the screen. If you just look beneath that, assumed overlap profit was $6,000 for this was for 6 months, which was already given to us anyway. Then what we do is we'll have to add overlap profit due to the change in accounting period, which is was 6 months long. We'll have to add that one as well into it. So the total overlap profit is going to be $9,000. Excuse me. Now, how we made this 9,000? How we calculated this 3,000, which is for 6 months. Reason we did this 3,000 is that if you look at the year of change, if you just look at the year of change, it is $9,000, isn't it? Right? Now we should have taxed $9,000, whereas we taxed $12,000. If you look at on the right side, 6,000 once and 6,000 again. So total taxed is 12,000. So obviously the extra which we have taxed is 3,000. You can simply say that. All right. Or if you look from the logical point of view, then what we can say is that overlap profit for 12 months was $6,000 which is given in the previous accounting period from 1st of January 2002 to 31st of December 2002. If you look at that one, then it is $6,000 which is for 12 months. So obviously half of that is going to be $3,000, which is for 6 months. So that's why we have to add that profit into it as well. All right. Now I've just made a mind map, so you can just remember this thing which we have just studied. Then you will have to see it yourself. It is easy to understand. Just look at the conditions which we must adhere to when we're making the change when we're making change in the accounting date. The following conditions must be met before change in accounting date is made. Change in accounting date is in the basis period is made or can occur. So the trader must notify HMRC by 31st January following the tax year in which the change is made. So for our current tax year, we must inform by 31st of January 2018. The period of account resulting in more than 18 the period of accounts resulting from the change must not exceed 18 months. So the maximum it can go is to 18 months. Now the examples which we have seen, the 4 cases, there wasn't any change which resulted in excess of 18 months long account period. The maximum was 18 months long, which we have seen in the case 4. Right? Then finally it says that there must have been no previous change made in the previous 5 years. So there must have been no previous change of accounting date in the last 5 years. So you can't do like that you have made a change in this year, then you want to change it again next year, right? So you cannot do it within 5 years. You have to wait until 5 years. All right. So we've concluded this this chapter, which is the basis period, and our next topic is going to be capital allowances. And the next chapter is. Let me just open up a question for you so that we can look at some question as well which is relevant to basis periods. Right? If you have a practice and revision kit in front of you, obviously BPP one, please open up the exam kit and come to page number 23 and question number 3, please. Question number 3. It is past exam paper which was examined in 2014 December attempt, although there will have been different tax rates and obviously different rules, but practice and revision kit guys have done some job for us. So obviously they have changed the tax rates and everything. If you go to the requirements section, please, and there are two portions. We'll just do the A portion, and we won't go to the B one because we haven't studied that so far. And if you just look at the A one, it says that on the assumption that P changes his accounting date to 28th of February, state the date by which he should notify HMRC of the change and calculate the taxable trading profits for each tax year 17-18 and 18-19. All right, so we have just studied in our conditions on the last page of our change in accounting date basis period, and we have just studied the conditions. So we'll have to see that when in which year he is making the change. So if it says if he makes the change of 28 February, so he's making the change. If you look at the figures above that, which is the table given to us, it says that he has made a change of 16 months ending 28 February 2018. So this is the year of change. So he's making a change in the year of 28 February 2018. So which tax year is it? It is 17-18, isn't it? So he's making the change in the tax year 17-18. So he must inform by 31st January after that. So obviously it will be 31st January 2019. All right, because it is tax year 17-18. So if you just tell him about the date when he should inform HMRC, you will get 1 mark. So you have already secured 1 mark by telling him that by what date he should inform HMRC, because he's asking about that as well. Now another 2 marks, remaining 2 marks are for calculating the taxable trading profits for each of the tax years 17-18 and 18-19. So we have to calculate the taxable trading profit. Now as far as the tax year 18-19 is concerned, for 18-19 tax year, simply £88,000 is the profit. But why £88,000? Because if you look at this date, it falls within the tax year 18-19. All right. So that is the reason that for tax year 18-19, we'll simply take £88,000 worth of profits. So that is for our tax year 18-19. Now only thing left for our tax year 17-18 is this profit, which the year in which he made a change. So when he made a change in the year the total profit was £94,000, right? And this is for months. This is for 16 months period. So $94,000 or pounds for 16 months. For 16 months duration. Now, if you look at the information which is given above, Mr. P began trading as unincorporated sole trader on 1st of January 2010. He always prepared accounts to 31st of October. Has overlap profits of 15,000 for 5 months overlap period. So he has already got overlap profits of £15,000, which is for 5 months. So how much is it for 1 month? Yep, £3,000. Then it says is planning to change his accounting date to 28th of February 2018. So he's changing his accounting date to 28th of February 2018, and he has already got overlap profits of 15,000 for 5 months. Now we just need to deduct 4 months worth of overlap profits, because months exceeding 12 months is 4 months. Because this profit is for 16 months, we only need to take the profit of 12 months. So we'll have to deduct 4 months worth of overlap profit out of this £94,000. All right. So for 4 months, it is going to be £12,000. So if we deduct 94,000 less 12,000, it is going to be £82,000. So £82,000 is going to be profit in the tax year 17-18. All right. Now, if you look at the next requirement, if it says anything, on the assumption that P changes his accounting date to 30th of April, state the basis period for the tax year 17, 18 and 18, 19, and the effect of this change on P's overlap profits. What would be the effect on the overlap profit? Whether overlap relief will be given or overlap, it will be added in the previous overlap profits. So he wants to know that as well. Now it is totally different from the previous requirement because he is making an assumption about the 30th April. Now for this requirement as well, you will have to assume that £15,000, £15,000, we have the overlap profit in the start of the question, so we haven't used that. All right, so it is totally different from the previous requirement. Don't assume that we have already used four months worth of overlap profits. So we already have we still have 5 months worth of overlap profits. So he's making change on 30th of April. So when he makes a change on 30th of April, so which tax year is it going to be? If he makes a change on 30th of April 2018, this is going to be 18-19 tax year. All right. Now when he makes a change and date is going to be 30th of April 2018, and the tax year is going to be 18-19. Right. So now one accounting date is coming in 18-19 and the previous is coming in 16-17. If you look at 31st of October 2016, that is 16-17. The next date is going to be 18-19 because we are making the 30th of April accounting date. So what is happening is that although that we have long period of account which is more than 12 months, but it is so long that there is no accounting date in a tax year. And now if you look at case number 4 of your notes, where the change of accounting date is made and which resulted in a long period of account which is more than 12 months, and it is so long that there is no accounting date ending in a tax year. So if something like that happens, then what we have to do, we have to follow few steps. Now first, what is the first step? The first step is that we'll have to take the new accounting date. Now the new accounting date in our case is going to be 30th of April 2018. We'll have to deduct 12 months out of that. So if we deduct 12 months out of that, it is going to be 30th of April 2017. Right? Now first accounting period is going to be ending on that date, so that is our first basis period. So first basis period is going to be 30th of April ending on 30th of April 2017. So obviously it will be from 1st of May 2016. So from 1st of May 2016 to 30th of April 2017, and the next one is going to be from 1st of April 2017 to 30th of April 2018. All right. Now that is case number 4. If you are struggling to understand that, please make sure you read the case 4 now and try to solve this requirement, which is requirement number B. Then you will be able to solve it easily. All right. Now about the overlap profits, now it will be added in the previous overlap profits. So whatever the overlap profit is, it will be added in the previous overlap profits. All right. Now what will be the overlap profit? If you look at the overlap profits, because there was a huge accounting period, and the amount has been taxed in 2 tax years, so that's why whatever the amount which has been taxed in 2 different tax years, we'll have to take that amount, and that will be our overlap profit, because it is added, because it is taxed twice, so we'll have to take that amount as well. All right, so you'll have to do it on the calculator, that which amount is going to be taxable and which is not. All right, I can't do it on the board, so you'll have to do it yourself. I've just told you the concept behind it. So for part A2, if you look at the part A2, that is the one which we are doing now, and it is relevant to change in accounting date, case number 4. Just read the case number 4 and try to solve this requirement, and you can always go back to the answers and recheck the answers as well. All right. Right then, that is end of our lecture. I won't be asking you to do the other bits and pieces of this question. Just do these parts which I have just told you. Don't go to other parts, because we haven't studied the stuff about them yet, so you will be just struggling and confuse yourself. Right, so just do part 1A, hang on, let me just check. on the exam kit. Yeah, part A1 and part A2 of question 3. Part A1 and part A2. Don't do other bits, the remaining parts for this question. All right. So that's it for this video, and I will see you in the next lecture with a new topic of ACCA P6 taxation. Good luck to you, and ta-ra.